A global rate hike nightmare is coming. It has been well over a year since central banks started raising rates. A global slowdown is happening, and Europe has slipped into recession. But I have bad news: rate hikes aren't over yet. We're going to have another move by central banks in the world to tighten even further. They have no choice because, on one hand, inflation is still crazy high, and on the other, that's all central banks can do: raise interest rates. And in our lead story today, Powell signals that the Federal Reserve is open to two straight hikes at coming meetings. And during the central bank conference, Powell told the world that he isn't done hiking yet. And listen to what he said. We believe there's more restriction coming. I wouldn't take moving to consecutive meetings off the table at all. He's warning us that more pain is coming for the economy. Now, it's not just the Federal Reserve tightening. The rest of the G7, they are moving to hike rates further because they have lost control of the inflation fight. Christine Lagarde from the ECB has come out preaching doom and gloom as well. She is telling the world we still have ground to cover and will very likely hike again in July. So the EU is also going to hike rates further because they aren't convinced that inflation has been solved. And if that isn't enough, we have the fifth largest economy in the world, the UK, expected to hike rates all the way to 6.5%. And this will drive the British economy into recession, but there isn't much choice. Core inflation has risen to 7.1%, and the headline CPI hasn't moved for 2 months in a row. Central banks in the West are essentially screwed. They misjudged inflation back in 2021, calling it transitory, right? And now they're trying to save their reputations by acting tough. And the problem with hiking further is the fragility of the economy. The banking crisis isn't solved yet, and the higher rates go, the more severe this liquidity drain will become. A perfect storm for the economy is coming, and we have to talk about this. And let's focus on the US economy because if that collapses, the rest of the world will follow as well. Welcome to globalization, guys. And this inflation fight is very severe, and the Fed has finally admitted the obvious that this state of affairs could last for years. So, how long will this limbo of higher interest rates and higher inflation last? According to Powell himself, he doesn't anticipate core inflation will return to the central bank's 2% target until 2025. So just imagine an environment of 4 to 5% rates at the very least until 2025. That's another 18 months of pressure on the economy, which is on the brink. But the Federal Reserve just let the cat out of the bag. Powell has admitted that the Fed doesn't really care about CPI inflation. He's truly worried about core inflation, the sticky parts of inflation that aren't coming down. Now, to really fight higher prices, you have to raise interest rates above the rate of inflation. So the CPI for May is at 4% and the Fed funds is at 5%. And by all measures, they should stop the hikes now. But Powell is still signaling he will continue to tighten. And why is that? Because the true metric he's tracking is US core inflation, which has stayed well above 5%. And that is a big problem. We can see that since January this year, core inflation has been fluctuating up and down, even though the Fed has been tightening. In April, it was at 5.5%, and it's only down to 5.3% in May, telling us that inflation is entrenched in the real economy. Even taking out food and energy prices are still rising. That's why it's not a surprise that Powell is moving to hike rates up to at least 5.5% or even more beyond that. The Fed paused their hiking cycle in June to assess the damage. Powell wanted answers to one question: can the economy survive 5% interest rates or will it implode? And what did we see? Absolutely nothing. The stock market is still rising higher and the labor market is still looking very resilient. The monthly job payrolls have been rising for 3 months straight, hitting 340,000 jobs in May. Businesses are still hiring, and to the Federal Reserve, it looks like a booming economy. Then you have the average hourly earnings still up by 4.3%. That's literally no change since the start of the year. The Fed wants to crush wages to destroy demand, but salaries are still going up. People are still out there spending. So the Federal Reserve, they have no choice but to tighten even further. And this is the warning Powell issued, and we have to pay attention to this. If you look at the data over the last quarter, what you see is stronger than expected growth, a tighter than expected labor market, and higher than expected inflation. And this tells us that although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough. And I don't think I've read a more clear warning. If the payrolls for June beat expectations of 200k, Powell will likely slap the economy with another rate hike in July. Now, Powell is obviously trying to downplay the odds for US recession. He can't possibly tell the world that the American economy is in trouble or it'll be a self-fulfilling prophecy. But if he continues to hike, something will break, and it just might be the banking system once again. The biggest risk to the banks today isn't US treasuries anymore. The Fed has managed to backstop that. But the big problem today is the commercial real estate bubble, which could pop if rates go any higher. According to Morgan Stanley, commercial real estate or CREs will crash harder than during the great financial crisis. This is a serious issue for the regional banks, and the problem here is the exposure to CRE loans. In a report by JP Morgan, the smaller regionals hold 4.4 times more exposure to US CRE loans compared to the bigger banks. And how much exposure are we talking about? Almost 29% of assets in the smaller banks are made up of CRE loans. In total, they hold over $1 trillion worth of these loans, and that is an extreme amount of exposure that could spark another banking crisis. And the smaller regionals know that. They know that they are overexposed. There's now a rush of US banks selling their loan portfolios to private lenders. They are afraid and they are getting out even though they have to sell at a discount. This is even before the Fed has hiked rates yet. The banks, they are anticipating chaos and they are moving to deleverage their balance sheet to stack cash. And putting up a story from Bloomberg, PacWest sells loans as private credit firms eye bank assets. And this first sale generated $2 billion for PacWest, and this selling is not going to stop. Listen to this statement from Ares Management, the buyer of PacWest loans. This is the first earning of the activity. What the banks are selling right now are their highest quality assets. They are short duration and floating rate. And let me translate that for you. The regionals are selling off their best loans to take as little haircut as possible. They want to contain the damage. But if Powell continues to hike even further, this will cause a further rush for liquidity. Then the regional banks will be forced to sell their lower quality CRE loans at a huge discount and take an even bigger hit. Now that's a really high possibility because the US banks, they are afraid of another liquidity crisis. They have nightmares of another wave of bank runs that could just collapse everything. We just need to look at the BTFP and the discount window. These are liquidity channels that banks rely on to borrow money from the Federal Reserve. Now the BTFP chart shows that banks are still heavily reliant on the Fed for emergency liquidity. Over $100 billion have been loaned out to the banks and it isn't dropping. The discount window also paints a picture of desperation. We have gone beyond the 2020 levels of liquidity panic. The banks have effectively borrowed over $260 billion from the Federal Reserve to shore up their balance sheet. And what we are seeing is a clear sign that the banks are gearing up for another potential bank run. And this is becoming increasingly real as Powell continues to hike. And this is where we need to zoom in and focus on the depositors, the people whose money is parked in the banks and they're very pissed off with their interest rates. And over the past year, over $1 trillion have left US banks to chase higher yields. We know that. It's going to US bonds, money market funds, and even the stock market. But things are going to get worse. A perfect storm is going to hit the US economy. And we talk about the $1 trillion aftershock that's coming for the markets. Now that the debt ceiling crisis is resolved, the US Treasury is moving to sell a ton of US bonds to fill up their accounts. And this is happening as the Federal Reserve continues to sell their own stash of bonds as well. And now Powell is signaling that he's going to hike rates even further. And this is very bad news for bond yields because they're going to spike even further, putting more pressure on the US economy. In a report by Reuters, US T-bill yields may not be attractive enough for money funds. What's happening is the flood of US treasuries is about to hit the market, but funds are hesitant to buy the bonds unless they offer higher yield. A lot of the money market funds are putting their money in the Fed's reverse repo facility because it just kind of makes sense, right? You get over 5% yield with zero default risk and instant liquidity the next day. And it makes no sense to buy bonds from Janet Yellen anymore. The treasury yields have to go up to compensate for the added risk. We need to understand this. And check this out. The reverse repo, which currently offers a 5% rate, will likely pay 5.3% if the Federal Reserve increases rates by another 25 basis points in July. And this means new treasuries from Yellen will have to be priced well above 5.3% in order to get buyers, or the US government will be broke. they won't have any money to spend. And guess what? This repricing has already started. Just a few days ago, the US Treasury, they sold bonds well above 5% because they are anticipating the Fed to raise rates in July. 120 billion in Treasury bills were sold. The 6-month bill gave a yield of 5.45%, and the 3-month bill gave a yield of 5.34%. These are very generous yields that will drain away liquidity from the system. So just imagine what will happen if Powell raises Fed funds to 5.5% or even 6% eventually. Short-term treasury yields will have to hit 6.3 or even 6.5% to get buyers. And do you know how insane that is? Bondholders are essentially getting 70% of the average annual return of the S&P 500 risk-free. That is guaranteed return, no questions asked. And that's why the banking crisis isn't over yet. This spike in bond yields will echo throughout the markets and spike yields for everything else, especially commercial real estate loans. And this is going to create a severe liquidity crisis for the banks if borrowers start to default. And here's the trillion-dollar question. What does this mean for the markets, especially when the economy is getting squeezed? Because these are two very different things. The S&P has been going up even though credit conditions are tightening. So what is going on? Basically, risk-taking behavior is back in the markets because nothing has broken yet. And that's why I'm still buying equities during this melt-up phase because no one knows how long this complacency will last. And what we need is for official recession to be declared, and then the markets could start to implode. Now, back in 2022, the US economy entered into a technical recession. I don't care what the White House said. It was a technical recession. We had 2 quarters of negative GDP growth. Q1 GDP came in at minus 1.6% and Q2 was minus 0.6%. Only then did the S&P start to crash to the low of 3600. So until a recession is officially declared, we will likely continue this melt-up phase. Stocks could keep going higher and higher until something breaks in the system. And this is the big fear that JP Morgan has. The worst liquidity crunch since the Lehman Brothers crisis will be the biggest obstacle this summer. And because of this bond selling and interest rate hikes, liquidity is going to contract by another $1.1 trillion from now till year end. And this would represent the worst US broad liquidity contraction since Lehman Brothers. Now, don't get me wrong, guys. This doesn't mean that stocks will go down. The stock market has been disconnected from reality for a very long time. There has to be some triggering event for the stock market to collapse. And the bank confirms this by saying this severe deposit contraction would not mean there will be less liquidity or cash to be invested in financial assets, but it would put more strain in the US banking system if these deposit outflows end up hitting vulnerable regional banks. So the trend for equities is up and up until either recession happens or the banks break once again. We'll be stuck in this twilight zone. We could have both interest rates going up together with stock prices, and the market is pricing in all this optimism that a recession won't happen and that nothing will break. But at the same time, the Federal Reserve is hiking rates to crazy levels. So something has to give. Something might really break. And how am I playing this? A few months back, I wrote a post about my own capital allocation and nothing much has changed. I'm 40% into money market funds because it is a no-brainer. The Fed has signaled that rates are going higher for much longer, so the yields will keep going up, and I'll make more on that side for at least the next 6 to 12 months. I'm also 25% into equities because God knows how long this melt-up will continue. I don't like this situation one bit, guys, but I can't time the markets, no one can. And JP Morgan has a very interesting chart that tells us the best time to buy is when a recession starts because the stock market is forward looking. It will crash faster than the economy and recover well before GDP starts to bottom. And back in the great financial crisis, the recession started in late 07 and GDP bottomed out in June 09, but equity prices cratered out in March 09 and started the recovery. So the stock market was 3 to 4 months ahead of the economy. And this means there's no point trying to time the bottom. A smarter move might be averaging in at the first sign of trouble. And no one can tell you how to play this, but be aware of a few things coming. Rates are likely to keep going up, at least another 25 or 50 basis points, and that is going to put even more pressure on the economy, especially the banks. But let me know what you think in the comments below, guys. Will Powell keep hiking interest rates, and will this cause another banking collapse? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.